So today, we're going to dig into a massive billion-dollar move made by one of the world's greatest investors. What on earth does Warren Buffett see in a healthcare company that, let's be honest, a lot of us deal with every single day? Well, we're going to follow the money and find out.
And that really is the big question, isn't it? Berkshire Hathaway, his company, they don't just throw around billions of dollars for fun. So what is the hidden value they've spotted in UnitedHealth Group? Let's start piecing this puzzle together.
And I mean, let's just take a second to really let that number sink in. $1.6 billion. You know, this isn't just a simple vote of confidence. It's a huge statement. It's basically saying that despite all the noise and chaos you hear about the healthcare industry, one of the sharpest investors on the planet sees a rock-solid future right here.
Okay, so if we're going to get inside Buffett's head, we first need to understand the beast itself. And UnitedHealth Group isn't just some big company, it's more like a two-headed giant, and it's got this powerful one-two punch that pretty much dominates the entire industry.
Just think about that for a minute. The company's services, whether it's through your insurance plan, maybe a local clinic you visit, they touch the lives of roughly half the people in the United States. That's not just market share, you guys. That's being a fundamental piece of the country's healthcare infrastructure. It's almost like the power company or your water utility.
Now, what's so fascinating when you look at a chart like this is where the money's actually coming from. So as you can see, that huge purple slice, almost 80%, that comes from insurance premiums. That's the part we all know them for. But look closer at those other slices. For products and services, they might look small in comparison, but they are the secret engine that's really driving this company's future.
And this right here is where you really see that two-headed giant in action. On one side, you've got UnitedHealthCare, the massive insurance business. And on the other, you have Optum, the services side. Now, here's the magic. Optum has all this data on which treatments work best, and that helps UnitedHealthCare price its insurance plans way more accurately. And at the same time, UnitedHealthcare's millions and millions of members, well, they provide a steady stream of customers for Optum's clinics and pharmacies. It's this incredibly powerful self-reinforcing loop.
So how does a giant like this protect its kingdom? We need to talk about its moat. You know, that competitive fortress that makes it so unbelievably hard for anyone else, even a tech titan, to try and challenge UnitedHealth's reign.
And look, it's not just one thing. It's like a four-layered defense system. First, its massive scale gives it incredible leverage over hospitals and drug companies. Second, that vertical integration we talked about, the insurance and services combo, lets it control its costs from top to bottom. Third, it is sitting on a mountain of data that it uses for smarter risk-taking. And finally, it's an absolute expert at navigating the ridiculously complex world of government healthcare. This fortress was seriously built to last.
But, you know, no fortress is completely invincible, right? A savvy investor like Buffett isn't just looking at the strengths. They're spending just as much time, if not more, scrutinizing the weaknesses. So, what are the real storm clouds on the horizon for UnitedHealth?
And this is where we have to be smart and separate the temporary headaches from the really permanent threats. On one side, you've got short-term stuff, like a sudden spike in surgery costs. Yeah, it's annoying for them, but it's manageable. The real danger, the existential risk, lies in the long-term stuff. A fundamental shift to something like a single-payer system could totally upend their entire business model. And of course, the threat of a truly disruptive tech competitor is always lurking.
Okay, so we've looked at the business, we've sized up the risks. Now for the fun part. Let's put UnitedHealth to the ultimate test, a classic Buffett-style investor checklist. Does this company actually have what it takes to earn a spot in the portfolio of a legend?
All right, first up on the checklist is quality and profitability. We're looking at return on equity, or ROE. It's basically a measure of how well a company uses its shareholders' money to make more money. Buffett, he wants to see a business that consistently earns above 15%. So does UnitedHealth make the cut?
And on this test, it is an absolute home run. UnitedHealth is a remarkably efficient profit engine. It has consistently delivered an average return on equity of around 20% for the last decade. That right there is the sign of a truly world-class business.
Next up, a test for safety. Buffett really dislikes companies that rely on a ton of debt because it just adds this unnecessary layer of risk. His general rule of thumb is a debt-to-equity ratio below 0.5. Let's see how UnitedHealth stacks up here. Aha! Here we've got our first little red flag. UnitedHealth definitely carries more debt than Buffett typically likes to see. Now, to be fair, its cash flows are so strong and so predictable that it can manage this debt pretty comfortably. But if you're a super conservative investor, it doesn't quite pass this specific safety check.
And now for the third and maybe the most important test of all, the price. You've all heard Buffett's mantra, buy a wonderful company but at a fair price. A price-to-earnings ratio, or PE, below 15 is a classic sign that a stock might just be on sale. So, is UnitedHealth cheap? So here's the crucial point. Usually, it fails this test too. The market knows this is a fantastic company, so it typically gives it a premium valuation. But here's the twist. In mid-2025, when the market was totally panicking about rising healthcare costs, the stock price briefly dipped into that value territory, the 12 to 14 times earnings range. And guess what? That was the window of opportunity. That's right when Buffett bought.
So we know that Buffett seems to have found a pretty rare opportunity, but what's the company actually worth? Let's get into it, let's run the numbers, and see what a detailed financial model says about its true intrinsic value.
All right, this is what's called a discounted cash flow analysis, which is really just a fancy way of saying we're projecting its future profits to figure out what it should be worth today. And as you can see, it gives us a range. In a really pessimistic, conservative scenario, the stock's worth maybe around $296, but in a more likely, base case scenario, it's closer to $570. And hey, if everything goes just right, it could be worth over $850.
So let's just focus on that middle-of-the-road base case. With a fair value of around $570 per share, and a stock price that at the time was hovering in the high 300s, well, the math is pretty clear. The stock was on sale.
And this isn't just my take. The financial research says it loud and clear. The numbers reveal this pretty significant gap between the market price and the company's real intrinsic value. This is the exact kind of mispricing that a value investor like Warren Buffett absolutely lives for.
Which, of course, brings us to our final big question. If the value is so obvious, what is the market missing? It really seems that while Wall Street is getting bogged down in all this short-term static, Buffett is looking at the long-term forecast. He sees a durable, cash-gushing fortress that's built to withstand pretty much any storm. Now, just a quick reminder before we go, all of this is for educational purposes only and is definitely not investment advice. You've always got to do your own research. Thanks so much for joining us.